If you have a mortgage, a credit card, or a retirement account, this video is about you, because the largest lender in the world is quietly walking away, and the cost is about to land on your paycheck. $850 billion. On paper, it looks like a statistic. In reality, it behaves more like a pressure plate buried beneath the global economy. As of now, China is standing on it. For years, investors were told the US bond market was unbreakable, too deep, too liquid, too important to fail. Any warning was dismissed as paranoia, a fringe theory, something to laugh at on late-night finance Twitter. But markets don't collapse with noise. They collapse with silence. And right now, something has gone very quiet. Mortgage rates are rising even as inflation slows. Long-term yields are drifting upward, ignoring speeches from the Federal Reserve. Housing affordability is unraveling, and Wall Street can't quite explain why. To understand what's really happening, you have to look past the headline number. Most analysts focus on China's direct holdings of U.S. Treasuries, roughly $750 billion, already massive, but incomplete. When you include U.S. agency debt, the bonds tied to housing giants and government-backed lenders, China's total exposure moves closer to $850 billion. That figure matters because it represents leverage. For more than 2 decades, the global economy ran on an unspoken agreement. China manufactured the world's goods. America consumed them. The dollars China earned didn't stay idle. They were funneled straight back into U.S. debt. It was a closed loop. Cheap imports flowed in, cheap credit flowed out, interest rates stayed low, mortgages stayed affordable, asset prices inflated gently year after year. It wasn't just trade, it was mutual dependence. But that cycle has fractured. The trade confrontations of the mid-2020s didn't just disrupt supply chains. They poisoned trust. Tariffs hardened into policy. Financial cooperation turned into strategic suspicion. And China began doing something subtle but irreversible. They stopped recycling dollars. Instead of rolling proceeds back into treasuries, they let bonds mature. Then they sold, quietly, methodically, without announcements. At the same time, something else began to happen. Gold shipments surged, central bank vaults filled, month after month, record after record. This wasn't diversification, it was insulation. China had watched what happened when reserves could be frozen with a keystroke. When access to the global financial system became conditional, they took notes, and then they acted. But here's the problem, and it's the problem Wall Street fears most. When a seller this large exits, someone else has to step in. And right now, no one is. The U.S. government runs on borrowing. Trillions in new debt every year, auctions every week. For decades, foreign buyers absorbed the supply, especially China. Now that buyer is gone. Worse, it's moving in the opposite direction. Picture a city where every homeowner lists their house on the same weekend, but no buyers show up. Prices don't drift lower, they collapse. Bond markets behave the same way. When bond prices fall, yields rise. Instantly, automatically. No debate, no vote. No emergency meeting can override that math. That's why rates are climbing even when policymakers signal relief. This isn't inflation pressure, it's a buyer vacuum. And the consequences are only beginning to surface. But what happens next will change everything, because this is where the illusion of central bank control starts to break. We are taught to believe that the Federal Reserve drives the economy from a command center. That with the right mix of words and rates, it can slow, stop, or restart growth at will. That belief only holds in calm waters. Long-term interest rates don't belong to the Fed. They belong to the market. And the market is reacting to one thing above all else: excess debt with shrinking demand. China's retreat has created a supply shock at the worst possible moment. The Fed is no longer buying bonds. Banks are already overloaded with government paper. Japan is defending its own currency. Europe has its own fires to put out. That leaves domestic investors. But to attract them, yields must rise. And when yields rise, borrowing costs rise everywhere. Credit cards, auto loans, corporate debt, and most dangerously, housing. The 30-year mortgage doesn't follow the Fed. It shadows the 10-year Treasury. Push that yield higher and mortgage rates follow whether policymakers like it or not. This is the decoupling. It means rate cuts won't rescue housing. It means stimulus loses power. It means debt levels now matter more than interest policy. Economists call this fiscal dominance. In plain terms, it means the debt pile has become too large to manage quietly. And this is where the geopolitical angle sharpens. China understands the structure of the U.S. economy. They know housing is its emotional core. When people feel wealthy at home, they spend. When that confidence breaks, consumption collapses. High rates choke refinancing. Commercial real estate already teeters. Empty office towers can't roll debt forward. Each percentage point increase pushes another building toward default. This isn't accidental timing. Technology sanctions, chip restrictions, strategic containment. The financial response isn't loud retaliation. It's pressure applied to the foundation. While this unfolds, another safety net has vanished. For years, excess liquidity sat inside a massive cash reservoir, a shock absorber that softened Treasury issuance. That reservoir is now empty, which means every new dollar borrowed must come directly from the banking system. Banks already carry large unrealized losses on bonds purchased at lower rates. Those losses remain hidden only as long as deposits stay put. But confidence is fragile. Rising yields deepen those losses. Withdrawals force sales. Sales lock in damage. We've seen this movie before, just on a smaller screen. The difference now is scale. There is no emergency program waiting in reserve. No backstop with infinite capacity that doesn't carry consequences. So the Fed faces a narrowing corridor. Allow failures and risk systemic panic. Intervene and expand the money supply. Either path erodes trust. Meanwhile, global energy markets are shifting beneath the surface. For decades, oil trade reinforced dollar demand. Now, alternative settlement arrangements are spreading quietly, bilaterally, outside the spotlight. Fewer required dollars means fewer reasons to hold U.S. debt. That's pressure from both sides, supply rising, demand thinning. The market senses it. Yields don't spike because of fear. They spike because of arithmetic. And arithmetic doesn't negotiate. And this is where the video takes a shocking turn, because the consequences don't stay in markets. They move into everyday life. When systems strain, wealth doesn't vanish. It migrates. The question is always the same: who moves first? History offers clues. In every debt-heavy era, those closest to the issuance source exit paper claims early. They exchange promises for tangibles. We are seeing that again. Central banks are accumulating hard reserves at rates unseen in generations, not because gold is fashionable, but because it has no counterparty. It doesn't require permission. It can't be frozen remotely. It doesn't default. This is about survival, not speculation. At the same time, traditional portfolio assumptions are failing. Bonds no longer hedge stocks. Liquidity no longer guarantees safety. Nominal gains mask real losses. Households feel it slowly. Groceries first, insurance next. Taxes creep higher as municipalities scramble for revenue. Then comes the confidence break. If housing stalls under elevated rates, the psychological engine of consumption stalls with it. Spending slows, growth contracts, revenues fall, and deficits widen. To close them, more debt is issued, which feeds the cycle. This is the spiral policymakers fear most, because it feeds on itself. The temptation will be to print, to stabilize banks, to support markets, to ensure functioning. The cost will be currency value, not overnight, gradually, relentlessly. And while markets may rise nominally, purchasing power erodes beneath the surface. This is how inflationary crises unfold, not with panic, but with normalization. People adjust until they can't. The final stage is psychological. When confidence in paper weakens, people seek assets that exist outside promises. Land, energy, metals, infrastructure, things you can't conjure with policy. This is why capital is moving now, quietly, strategically. Not because collapse is guaranteed, but because risk has become asymmetric. And here's the truth most people miss. By the time official warnings arrive, positioning is over. Doors don't close with alarms. They close with excuses. The shift underway isn't about China versus the US. It's about a global system transitioning from abundance financed by trust to scarcity governed by math. And math always wins. The silent shock isn't coming. It's already moving through the system. The only question left is where you're standing when the transfer completes. This is exactly what Economic Tales exists to unpack. The hidden mechanics beneath the headlines before they become obvious. If you want to understand where the system bends next and how to recognize the real warning signals before the crowd reacts, stay with us. Because the next chapter isn't about markets. It's about survival in a new financial era. And most people never see it coming.